Hi everyone, I'm Sarah Stokes and this is your mortgage market closing bell for Friday, July 31st. Every Friday I break down what happened with mortgage rates, why the market moved, and what buyers and homeowners and real estate professionals should watch next. Mortgage rates ended this week close to their highest levels in about a year. According to Mortgage News Daily, the average top-tier 30-year fixed rate closed Friday at approximately 6.83%. That was 6 basis points higher than Thursday and 2 basis points higher than last Friday. So the weekly change may not look too dramatic, but underneath the surface, Friday was a difficult day for the bond market. The 10-year Treasury yield climbed to approximately 4.74%, and mortgage-backed securities sold off sharply. Mortgage bonds directly influence the rates lenders can offer. So when MBS prices fall, mortgage pricing usually becomes more expensive. There were several reasons for the weakness. First, we received the Federal Reserve's interest rate decision Wednesday. The Fed, or the FOMC, held its benchmark rate steady at 3.5% to 3.75%, but the decision was not necessarily comforting for the mortgage market. 3 Fed officials actually preferred a rate increase, while Chair Kevin Warsh said the Fed remains committed to bringing inflation down, but he didn't exactly provide a clear guidance about what's going to happen in September. There's another FOMC meeting in September. That uncertainty contributed to a very unusual reaction. Short-term Treasury yields initially moved lower because the Fed did not raise rates, but longer-term Treasury yields moved higher because investors remained concerned about inflation and the Fed's credibility, to be honest. We all received the Fed's preferred inflation measure. Headline PCE inflation slowed to 3.7% year over year, and core PCE eased to slightly 3.3%. That was an improvement, but inflation is still well above the Fed's 2% target. And then Friday's employment cost index came in slightly hotter than expected, showing that wages and compensation remain firm. And oil continues to complicate everything. Brent crude moved back to approximately $90 per barrel as conflict and shipping disruptions around Iran and the Strait of Hormuz intensified. So why does this matter for mortgage rates? Or for buying a house, right? Because higher oil prices can raise gasoline, transportation, and production costs. That can create more inflation. Inflation is one of the biggest enemies of mortgage bonds. So let's look at next week because it is packed with employment data. On Monday, we get the ISM manufacturing. Tuesday, we get JOLTS jobs openings. Wednesday, we receive ADP private payrolls and ISM services. And Thursday brings jobless claims and productivity data. And then Friday is the big one, the July employment situation report. That report gives us payroll growth, unemployment, wages, and revisions to previous months. A softer jobs report could help Treasury yields and mortgage rates move lower. A stronger report, especially when showing elevated wage growth, could actually push rates above the recent 6.85% high. For buyers, the goal is really not to perfectly predict the market and where interest rates are going to be. The goal is to understand your payment, your timeline, and your risk, and then you make a strategy that fits your situation. I'm Sarah Stokes with Coast to Coast Mortgage Lending. Follow me for your mortgage market closing bell every Friday, and reach out if you would like for me to calculate what today's rates mean for your personal buying power, and have a wonderful weekend.